And let's do this. All right, so good morning, good morning, good morning, Grand Rising, and we're going to get straight into it. So what we're going to do is we're going to go over yesterday's trade was USD JPY and look at it fly. Look at the trade fly. So the entry, obviously we had this in regards to understanding this market pushing up above these highs. And we're going to go and break it all the way down from zero. I'm going to delete everything off my chart. But the entry for this right now, this is going for it, going at the clappers, was down here, was this little guy. There's this little guy over here, if you can recall yesterday's session, which unfortunately wasn't recorded. Actually, it was recorded. I recorded it hard copy, I think, to the cloud. And the entry was down here, if you remember, with a stop of 15 pips. Because can you recall yesterday I was saying to you guys, let's keep it open, 50 that, because there was right at a market open, we saw a huge whip downstairs, bearishly to grab liquidity, okay? Nam, and then it left the building. It's going like the clappers. And personally, what our targets was for this is we was looking at this really continuing to push up and capture liquidity all the way up here around the 151.88 kind of level. We shall see if we get all that way. Either way, I'm in that trade. I'm totally risk-free, and it's currently in 4 figures, all right, which is all right, and it's pushing up. And we're going to go and look at US30. But what we'll do is we're going to break this trade down. I'm going to break down why I got into this trade. Yeah, let's do that. Let's break it down and understand why I got into this trade, all right? Very simply, and see if we can get some questions answered, because it's a very, very small group this morning, so we can, be more specific to your needs, answer any questions that you're doing. All right. So first and foremost, USD JPY. Let's understand. Let's get busy and understand. Always, we're always gonna have it up, so it's always in the back of your mind. Yeah, you've seen it before. You're gonna see it again. It's our Russian doll view. Understanding that the markets, are fractal. Yeah, meaning that same thing happens within every time frame, from large. Moving down. It's the market is happening within another time frame, and that's happening within another time frame, and that's happening within another time frame. If you think about it from a Russian doll perspective, you understand that this 5 minute, for argument's sake, if I go and look at this guy over here, that this 5 minute has to respect what's happening on the hour. And that hour has to respect what's happening on the 4 hour, and that 4 hours has to respect what's happening on the daily, and the daily has to respect what's happening on the weekly, and the weekly's got to respect what's happening on the monthly. That's how the markets work. Do you understand what I'm saying? It's that respect. Okay, so if we understand respecting your elders, that's what we're talking about. So when I come to a market, any market, the very first thing I'm going to do, the very first thing I know Jason's going to do, the very first thing I know Jivan's going to do, the first thing I know Ash is going to do, is we're going to start on a larger, higher time frame. Now, why is this? Because this is like any other investment. Right now, if Jivan said to me, listen, I've got some company called, I don't know, what it's got, Jivan Living. I'd like you to invest in it. Well, I'm going to be like, okay, so what is it? What is that company? And what has it done in the past? That's exactly what we're doing by zooming all the way out and looking at this market from a higher time frame. We're basically saying, I don't know anything about USD JPY. What is it? What has it been doing? Okay, it's been bullish. Look, I can now see as a fact, not an opinion, that from 2011, this market has been bullish, making higher highs and higher lows, and higher highs and higher lows. All right, so it's trading within this range. That's not an opinion. All right, that is a fact based upon data. Okay, and then I can turn and say, okay, then let me zoom down a piece, because I'm not going to be sitting around here for, every week waiting for a candle. So I'm going to zoom down to my daily time frame. I'm going to understand just a bit and more what's been going on in this market. Okay. So we can see a few things. For argument's sake, we can say this market's been on some sort of trajectory like so. All right. Yeah, just about, I'm going to say like so. Making higher highs and higher lows and higher highs. And right here, we can see 2 equal highs. So I don't ignore that, because I have to look at all the data. Whatever data is there, I'm going to use it, because unfortunately, I cannot predict the future. I cannot analyze these charts based upon what's going to happen in the future. I don't have a crystal ball. I don't know what the market's going to do. But I can look backwards in history to look at data to give me an insight of what market behavior may ensue. For example, we can see these equal highs, and we understand that above equal highs sits something that we call liquidity. All right. Liquidity, very simply, is a pool of capital. It's a pool of money whereby people believe that for whatever reason, this level up here is, very strong level of quote unquote resistance. Okay. And we see stop losses. We see people turning around and sellers placing their stops from up here, believing that this market is going to be like, this is a good place to sell from. All right, because it's a higher price, which is maybe the truth. It's the top of a range. But the reality is we understand when we're not, we've got some education and we've seen it time and time and time again, that the market likes to go and eat liquidity. The market likes to go and take liquidity, before making a decision of what it wants to do. So therefore, liquidity is a draw on price. It's like a magnet to price, okay? Now, if we wanted to knuckle down further, because even though I said them on my daily, we're not looking at the latest daily impulse. We can see how the market pushed up here. Have a look. This is us drawing our trend lines as a guide. We don't hit the button based upon, price hit one of our lines that we draw on our screen, on our laptop. That's not how it works. But we use these lines as a guide for our eyes. So we understand what these markets are doing, especially if it's a market that you haven't traded or it's a new market. So we can see this market was doing this. Pushed up over here, then it pushed down over here. And at the moment where we are right now is the market, from a daily perspective, has been pushing up on this impulse, which I'm going to change the color and I'm going to make it green. We've been pushing up in that impulse. And if you want to put a top end on it, you can hold control on the Windows machine and take a parallel line, and that is showing you the range. Now, what does that mean? We've got somebody in here, a new trader. I know he's not necessarily well versed in technical analysis, but I'm trying to explain this to you, and I try to give this information in the most concise way, all right? That at the end of the day, and the simplest way, I don't want to overcomplicate this. We've got Ash on the call. If he wants, you can unmute your cameras. And anyone who's here, if you're in a decent position, you can unmute your cameras. There's only a few of us on there, yeah? The reality is this. I'm going to explain the markets to you, Ash, within this session so that you understand and you will always be able to make a decision about your investments. I understand that you're interested in investments. Unmute your camera there, Max, Ash, if I can see if you're decent, so I can see you. I'm talking directly to you, all right? So,
hey, how you doing?
How you doing, my man? So listen. So in regards to the markets, this market here is USD JPY, which is a US dollar against the Japanese yen. But I'm going to make it the property market in Dubai. Okay, I'm going to make it the property market in Dubai because this can be a market for anything. It could be a market for trainers, it could be a market for hair products, it could be a market for cars. It doesn't matter. Markets move in trends, as you know. Think about the property market. Okay, so right now, what this is showing us from that larger time frame when I was looking at it, showing. I'm not going to call it USDJP. I'm going to call it the Dubai or the UAE property market, and it has been bullish. This is language for going up, making higher highs and higher lows and higher highs, simply meaning that if you bought property in the UAE back in 2012, you would have seen gains by 2024 because the market has been going up. Whereas if the market was bearish and you bought property in 2012, and I said the market was bearish, well, it would be making lower lows, lower highs and lower lows, and you would have seen a loss if the market was bearish. Okay, so the market is bullish for argument's sake, but that doesn't necessarily help us as day traders, okay, to make an investment right now in the markets, because right now we're looking at a chart where every single one of these candles are a month. That's why it says M over here, a month in time. All right. So, for me, who wants to get in a trade in and out in the next couple of hours, it's not it's not enough information. So what we do is we drop our time frame. We can drop down to our weekly, our daily. All of these here are time frames: 8 hour, 4 hour, 3 hour, 2, 1, all the way going down to 5 seconds. I can get a chart where I can see candles every 5 seconds. At the moment, I can only see a candle every month. If I drop my time frame down to a daily, it gives me information It gives me more information for me to be able to say, okay, this is what's happening. So the daily time frame, we can see how the market came up here. Yeah, and this is Wednesday, the 15th of November, came up to this high, and then it started to break structure, we call it, and push down bearishly. Now, structure is simply understanding that these markets have a structure. The structure is this: either bullish, making higher highs and higher lows, either bearish, making lower lows and lower highs, yeah, or sideways, okay, making equal highs, one second, sideways, making equal highs and equal lows. This can be the same for any market. Think about it. Sometimes the market's going up and everyone's bullish, everyone's buying property in Dubai, and other times the markets is going down and property prices are falling. Or sometimes the property markets are just stable. People are trying to work out whether or not, you know, they want to be buying, they want to be selling. Sometimes they call this consolidation or accumulation when it comes to trading, accumulating orders. All right. Now, right now, I'm getting some further information that I can see that from this daily time frame, meaning that every single one of these candles is a day in time, taking me all the way back to the 3rd of January here. If I put where my crosshairs are, I can see that this market has been making a bullish impulse. But I also identified pretty early this blue line here, which I said was liquidity, which I also said is a draw on price. We have 3 touches. Well, let's just say 2 touches in here, and here, which are some equal highs. And all you need to understand for now about liquidity is it's a draw on price. It's an area where the market likes to, you know, return to, because trading is a zero-sum game. What do I mean by that? I mean, like, for you to win, someone else has to lose. Okay, that's how it works. Why is that the case? First, think about a market. If you went to a market, an actual souk, yeah, to go and buy something, you've got to, when you give the man, you know, money for your iPhone case, you have to take an iPhone case away from his inventory. Do you understand what I'm saying? It's a trade. It's a trade. You're trading this for that. Yeah. So we're in a market, and what's being traded is money. What's being traded, what's on the table is cash. So if I win, I took from someone else who took the other side of my trade. All right. That's a concept you have to understand. All right. So as you can see right here, this market on a daily time frame, going to present time now, not the past, going to what's been going on since January, has been making higher highs, higher lows, higher highs. And we have a saying here that the market will continue to do what it has always done until it does something else. Because one thing we know about the market is we do not know what the market's going to go and do. I don't know whether or not the market's going to decide, you know, there's going to be some sort of explosion that happens in a financial center somewhere. You know, 9/11, nobody was expecting that, supposedly. And when a plane crashed and hit, you know, a financial epicenter, you know, this had an effect on the stock prices of many industries. Yeah. COVID-19 came and everything shut down. This has an effect on the markets. All right. Now, there are daily events, daily red folder events, daily news events. All right. That affect the markets. All right. Now, you spoke to me about NVIDIA. NVIDIA is a company that sits within the US 30, the top 30 US companies. All right. So therefore, when NVIDIA starts doing extremely well, they control a certain percentage of those top 30 companies. So when they have fantastic earnings and, you know, they're doing very well, it pushes the US 30, which is an index. It is a basket of goods. It pushes that entire market, the US 30 market, pushes it up. You know, and vice versa. If an Apple or a Microsoft or one of the big boys had really bad results, because they control such a large percentage market share of that market, it affects things. And this happens daily, as I was just showing on this website here, which is an economic calendar, showing fundamental things that are happening in the world. Goods trade balance. Yeah, for you, and we always look at USD because USD is the most, it's the major currency of the world, essentially. Okay, which lots of companies are trying to change. Lots of countries want to change. Okay, we've seen something called BRICS agreement, where you have different nations trying to come together, make their own kind of super currency, etc., etc., etc. At the moment, and for the foreseeable future, the USD is the currency of the world. Okay, everything is paid in dollars and blah 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 and blah blah blah. Oil is bought in dollars, and this means that when we're looking at major news, we definitely want to pay attention to USD major news. This is major news that's happening in the United States of America. All right, and that's going to affect the US dollar. All right, so here we're showing red folder and orange folder news, but the bottom line is that all of these here, these speeches, Fed Collins speech, blah blah, all of these have, at least they have short-term effects on the market, at minimum, short-term effects. Obviously, major events, major things, changes in interest rates, this, that, and other, wars and this and COVID, major things can have major effects on the market. But at minimum, fundamentals have, short-term effects on the market, and those short-term effects, whether they're going to be for a week or a day or whatever it may be, that can substantially affect our day trading. Okay, all right. If I drop my time frame down further here in this USD market, USD JPY market, we can see that this market was making higher highs and higher lows and higher highs and higher lows and higher highs, and then it started to go sideways. We must be able to identify these cycles and these phases of the market so that we can make a decision of what it is that we want to do. Okay, so when this market was making higher highs and higher lows and higher highs, we want to buy this market, but we want to buy when things are cheap. We don't want to buy when things are relatively expensive. Now, what does this mean? It's very, very simple. It's the same principle. Like I said, if you wanted to forget about this being USD JPY, think about it as any other market that you could wrap your head around. If you was going to go and buy a car, and this was the chart, you decided in what's the date? February, that you want to go and buy a new Range Rover. Okay, I know you like the Ranges, all right? And you're thinking to yourself, yeah, I want to buy a new Range Rover, and you know that they're generally getting more expensive, yeah, and they're generally getting more expensive within this range, all right, within this range. So therefore, even from a very basic perspective, you want to buy it now. You want a Range Rover, you want to be driving it by the summer or whatever it may be. You want to buy it now. Surely it's going to be better for you to be buying it here or here or here, because within that range, this is the cheapest price. So let's imagine that you woke up in February the 2nd. It's like, I want to buy a Range Rover. By the time you started doing your looking and stuff like that, it took you some time, and prices went all the way up here. All right. When price came back down to this level here, and you understand that this is a range, you're like, this seems to be a good price. It would have been better that when I first started looking, I bought. But unfortunately, you can't go back in time. So the next best price would have been here, but you're still dilly-dallying around a little bit. Price goes up again, and you're like, oh, wow, they're getting more expensive again. But I'm going to wait until price gets back down to cheap. And when I say cheap, it's cheap within this range. So here, cheap within that range would be here. When price gets back down to here, it's a good price, a fair price to pay. Yes, it would have been better you bought 4 a month ago, but this is a fair price to pay. And vice versa. You don't really, unless you just bought it out of control. And even then, doesn't matter how much money you have, it matters how much money you keep, okay? You don't really want to be buying, when it's the most expensive that it's ever been. So if you're looking at a range right now and you're thinking to yourself, okay, you don't want to necessarily buy over here when it's the most expensive it's ever been. You don't want to necessarily buy over here, because think about it, this is going back in time. Let's rewind it so you can't see the future. You only know, this is all you know. You don't know what's going to happen next. All right, this is all you know, because this is present time, for example. You don't want to buy here. You're looking back in the past. You're like, this is the most expensive they've ever been. You don't really want to buy there. You want to wait at least till you get that down to a fair price. And that's within a range. And that happens within whether it's bearish, whether it's bullish, whether it's going sideways. The basic principle of selling at a premium and buying at a discount is universal to all markets and all settings and all situations. And I make it very clear. I don't care where I am. I don't care if I walk into the Gucci store or I'm walking into, Sainsbury's to buy my. I want to get everything cheap. Like, I'm going to go to the counter and be like, £500 for that jacket. I mean, surely that's not the best price. Surely you can sort something out. And the person behind the counter is going to be like, well, I'm not supposed to, but I suppose I could give you 20%. Yeah, I'm happy at 20%. Let me have that. It's not 80%. but it's cheaper. I want to buy things when they're cheap opposed to buying. And this is the same principle in the markets, or vice versa. I want to sell when they're expensive. All right. So when things get expensive, I'm interested in saying that basic concept just goes out of people's head when they're trading. And they forget about that. They just think yourself it's some new kind of nuance, some dark arts, and they're doing this and they overcomplicate things. All right. So within that space, you can see how this market here is pushing up, higher highs, higher lows, and then started to go sideways. Look how clearly it's going sideways. All right. Now we was looking at this market yesterday, and I said the way in which this market is right now, as though it started going sideways, it started sitting on this lower trend line over here. I said it's right at the bottom of this trend line over here. And the market, this is, look, have a look. If I lie there, this is Breakfast Club over here, Tuesday. If I put a vertical line, Tuesday, around about this time, is Breakfast Club. And I said, the way this market's coming down here, and I've seen it ever so slightly, this market's is sitting on this line here. I said, look, if we start breaking structure here, it may be of interest to me to take this trade for a few reasons. First reason is this. We can see this liquidity sitting above that range, okay? And all the way up here, you know, the bigger liquidity pull on price all the way up here, which is from, if I zoom out, you can see these equal highs that we identified over here, all right? So that pull on price, that pull on liquidity over here, yeah, is always in the back of my mind. That's where market wants to drive to, as well as the fact that we're touching on the bottom of this range, that green line that I've drawn in here, which ultimately is cheap within that range. Yeah, within those two green lines, that bottom over there is cheap within that range. And I've just said pretty clearly that I want to buy things when they're cheap. I want to sell them when they're expensive. That is a basic principle. Okay, so therefore that kind of gives me a bit of a bias of what I want interested in doing. And we saw over here, this is Breakfast Club, me turning around and saying, okay, let's drop our time frame down. Drop down to our 5-minute time frame, all the way in here. And if I was to draw in some lines, my lines would look like this. First and foremost, we'll have one looking like this. Can you see this? How? I'm going to make it small. I'm going to make it white. Why would we have one looking like this from the 15-minute time frame? Because let me rewind, in fact. Let me rewind. I don't even want to give it to you like that. Let's do it like this. Let's rewind it. All right, let's rewind it back in here. Okay, so that would be my line. My line would be looking like this. Why would it be looking like this? Because it's touching the last high before the lowest point. And we saw the market dive into this area in Breakfast Club. Dive in. All right, so let me drop my time frame down to a 5-minute time frame so that we can get more information upon this dive. So we're looking like this on this dive. Okay. I was saying, all right, in this session, clearly I said, look, I'm going to have to drop my time frame a little bit lower because it's a bit hard to see structure. Like looking at that 5-minute time frame, though I can see the structure, it's a bit difficult to see those higher highs or those lower lows and those lower highs. So I dropped my time frame all the way down to a 2-minute, 1-minute time frame, just so that we can see, for educational purposes, how that market was moving structurally. And we saw it moving like this, like so. Okay. And if we wanted to, we could put in a bottom end to the range, but we don't need to. We saw on this 1-minute time frame, have a look at this market. I'm looking for indication, correction, continuation. I'm also really looking for the market to price to break outside of this white line over here. I wanted to break outside here and start doing something here, to be honest. If I want to be very early to the market, right now this market, look, have a look. Here's structure. Have a look. There is structure here. Okay, and here on a smaller time frame, and here on a smaller time frame, and we've seen the first little indication on a very small time frame, which is 1-minute time frame, for indication of what the market wants to do. So it makes me feel to myself, okay, possibly. And we've seen it indicate, we've seen it correct. And remember, I was saying this, it was doing a hokey cokey. This was all happening yesterday's session, but those who are on the session can remember. And I said, right now we've just got to close above. So here's the indication. The whole confluence looks like this. Indication, breaking this structure here, minor structure on a 1-minute time frame. So this is very aggressive. This whole energy here is correction. And this whole energy here is the continuation. Why is that? Because this correction didn't come down and break structure. If it did, it'd be void. I mean, start again. But it didn't. It would just danced around, because on on a larger time frame, you wouldn't see all of this. So on a 5-minute time frame, look, you can just see it indicate up here, correct, and make a higher high and close above. Let's go back to our 1-minute time frame. Now, I said at this point in time, I said, look, this level in here, this line in here was that bottom of the range where things are cheap. And then when we've seen it push all the way down there, understand that what we've seen is a capture of liquidity that was sitting below this level. If I was to draw a little square in here, all right? Little rectangle in here. Below these levels all in here, below those levels is liquidity. Below those equal lows is liquidity. All right? So when this market was diving down here, I knew why it might want to dive down here. Because of the liquidity. All right? I knew why it might want to dive down there. All right? So when we saw it sitting in here, I said, okay, look, I like this trade if I can see an indication correction continue, because we're at the bottom of the range, i.e. we're cheap, okay? And there's liquidity above, and it just captured liquidity below. We know when it captures liquidity below, the market has to run in the opposite direction. We know that liquidity is a draw on price, which is above. We know that we're waiting for our confirmations, but I said we're going to have to be quite small to get involved, all right? And on the session, I took the trade. I actually said when I took the trade, I said what I'm going to do is I'm going to make sure that my stop is all the way outside of this level here with some room, all right? And I think at the time, the conclusion was about 15 pips or so, okay? When that candle closed, about 15 pips or so to get into that trade on the basis that I am targeting the liquidity above. The liquidity above is at minimum here, okay? Let's see what happened. All right, let's see what happened. I'm going to hit play. I'm going to speed it up and hit play. I'm just trying to zoom in a bit. So we saw that the market started to move in our direction. Lovely. Now, understand when markets open, we're getting here. So it's 12 o'clock now. It's 12:30. All right. When markets open, we did see some, there you go. That was the market just saying, look, we are ready, like we want to go up, but we want to get some provisions beforehand. And because where my entry was here and this little space, there was a space here below wherever I entered, there was some room. This didn't stop me out, okay? This was literally just a liquidity grab, a very, very fast wick that pushed in the opposite direction. Even if you got stopped out in here, I would advise you to get back in for the speed of how it came back and broke structure, retraced, indicated, continued. I would have told you to get straight back in, okay? If you got stopped out, I didn't get stopped out, and neither should anybody else got stopped out, because I told you at the time that we was going to have our stop like below here with our spread ×2. So you'd have been good. The market continued as we thought to make its way, and I'm showing you on the 1-minute time frame, so you've seen a lot of action. But on a 5-minute time frame, this looks a lot calmer. All right, on a 5-minute time frame, this looks a lot calmer. The market continued to make higher highs and higher lows and trade towards liquidity. All right. Now, for me, in this position, I want to see this market go and capture this liquidity all the way above here and beyond. All right. I'd like to go and see it capture that liquidity all the way up here and beyond, to be perfectly honest, all right? And have a look where we are at the moment. To me, I can't see any reason why this market right now wouldn't go and at least wick up and capture this liquidity. So I'm still in the trade. Yeah, I'm still in the trade, calm. It's completely risk-free, meaning that my stop is above my entry, yeah? It's completely risk-free, and I'm in a position whereby now I'm managing this trade of how much money I want to take out of it. Now, if I want, I could trail my stop and start placing and here's a good bit of education. If you're trailing your stop, what you want to do is you really want to place your stops below structure. And if you want to stay in the trade, you should even give yourself some space below structure if you want to stay in the trade. Okay. So say, for example, here is the structure, this low, but I might put my stop just a bit below this little bit of structure in here, for argument's sake, because then you're protecting yourself from liquidity grabs before it continues to go on its way. That's if you want to stay in the trade. If you're very, very happy with your profits, and you're like, listen, I'm over the moon with my profits, you can place your trade below the most recent structure based upon your time frames. So you might turn and say, look, I'm in such good profits, 5-minute structure, mate. I'm moving my stop. So from here, you're moving your stop from here, under here, and then you're moving it under here. Because you're basically saying, I want to get stopped up. I want to get stopped up for as much profit as I can do so I can put that money in my pockets. So I'm just securing my profits. You're manually trailing your structure. And you can manually trail structure on a 5-minute time frame, a 15-minute time frame, whatever. Maybe obviously, if you can see ones aligning, like this here is 5-minute and 15-minute structure, where we saw an indication happen, breaking above this level here. We saw an indication, we saw a correction, come back down to where the battlefield was. All right, remember all of these analogies? And we saw a continuation. Well, this is quite a strong level of structure to say you're going to place your stop at. Yeah. Obviously, these ones that I'm placing up here underneath the 5 minutes, they're less strong because the market could, if it wants to, have a look, even if I was to draw in a range, even if I was to draw in some lines in here, have a look. Let's even do this last impulse like so. But even if I was to draw that little range in here, there's a possibility this market wants to come down and touch the bottom of this range, just in regards to this current impulse, let alone this larger impulse like so. So me moving my stop, for example, up here, I've got a much higher chance of it stopping me out and then continuing to push up. Yeah. So the strongest, when you're seeing structure align, 5-minute, 15-minute, and that's probably going to be our structure. There's a slight out, you can slightly slit in here. That is a stronger place. Or not say stronger. That is a safer place to put your stop for you to be stopped out. If structure breaks there, it's possible something else has happened. Yeah, but it really depends upon your trade management. Because if you're managing this trade on the basis that, bro, I'm already at 1 to 5, I just want to place my stop at a place where I'm not going to lose too much money. Well, you can drop your time frame down to a 5-minute. I wouldn't advise dropping it down to a 1-minute structure. I wouldn't advise that. If that's the case, you might just stop yourself out at the highest point and just take the money. All right. But on a 5-minute structure, you can easily say and say, look, bro, I'm placing my stops below this 5-minute structure because I really don't want to lose too much money from my profits. Okay. So yeah, that was the USD JPY trade. I'm still in it at the moment. I'm watching it. I've got my chart set to 5 minutes, and I'm just looking at it. And I've got an alert, and you can use the alerts to show you when your market's doing something mad. Like right now, this structure hasn't been completed. Look, we made a higher high, higher low, higher high. We made a slightly higher low here coming down to this wick, but the higher high hasn't closed yet above this wick. All right, let me zoom in so you can see what I'm talking about. All right, right now, this higher high, if we're saying that we're looking at structure, higher high, higher low, higher high, higher low, this higher high hasn't closed yet above these wicks. So if I wanted to, and I'm a bit concerned what the market's going to do, I could start placing some alerts. I could just tell and say, you know what? I don't really want to lose too much money. Let me place I don't have to move my stop there to necessarily stop me out, but I could place an alert over here if this market decides it wants to start tumbling down back towards this structure. I could place an alert there just to see what's going on, whether it's happening, see what the price is doing. Was it just a quick wick that happened from some news? Or was it, the market slowly making that structure? So either way, that's how you trail your stop manually. You look for the structure and you're going to place your stop below that structure if you just want to protect your profits, or you're going to place your stop even a little bit away from structure, especially if that structure aligns on another time frame. You're going to place it away from that structure to protect yourself from the market wicking down, capturing liquidity as we know it likes to do, and then deciding it wants to go. And then you're looking at your charts later on in the day like, oh my gosh, it went for a billion pips and you got stopped out over here. So that's all about trade and risk management. This is the difference of how I can tell you to take a trade. We can all take the same trade, but I made X amount of money and you made this amount of money or no money. It's about trade management. It's about right now, somebody might just close their trade and take the profits. If that's the case, they've won. They've won, they've bagged their profits, it's in their pockets. Someone else hasn't moved their stop. Someone else has not moved their stop, and their stop is all the way quay down here. And for whatever reason, some crazy news comes out today, and this absolutely tanks, and they lose money. So we both took the same trade. I banked money, you know, a 1 to 8 trade, and they lost money. Why? Because the trade management was different. We managed, somebody else broke even because they left their stop just above. So this is why when you just hear, yeah, man just gave signals, or man just said this, or man just said that. Even when he gives that signals and he says the TP is at this price, and the TP never got to that price, he may have still made money, but you didn't. Yeah? Or he may have still, you know, broken even and you took a loss. It's about trade management. This is the other chapter, the next chapter. After you know how to get into trades, how do you manage your trades? How would I have scaled into this trade? So instead of me being at a 1 to 7 and 8 now, I'm at a 1 to 16, 1 to 24. Well, I would have done this. I would have gotten into that trade where we got in. You know, so let's just say for argument's sake, you got in here and this trade started running in its direction. You weathered the storm of when the markets opened here. Look at this wick. Yeah. This is showing me 130. Am I on the right time? Yeah, around about 130, we saw this big wick push down before, whatever it may be. Yeah, so just before the market's officially opening, etc., to grab liquidity. But we stayed in this trade right. And as soon as I saw this market indicating, have a look, here's structure. Indicating, correcting, and then continuing, I could have turned around and said, you know what? I could have taken another position with my stop below that low. So now I've got 2 positions, and that first position over here is totally risk-free. So I've got 2 positions, but 1 set of risk. All right? So that position is now running. Obviously, I'm showing you on a 5-minute time frame. On a 1-minute time frame, it's a much better entry than this. But I'm just showing you on a 5-minute time frame because that trade now, that second trade would be like this at the moment. Okay? After that indication of breaking major structure, yeah, after that correction, that continuation. And then the markets, look over here, even here, look, you started getting shook because here was structure and the market came and broke that structure, an indication it wants to go in the other way. So you're shook right now. You're like, oh my goodness, but what did it do? Did it correct? Did it correct? Did it continue? No, it didn't. Came up here and broke structure and kept going. Yeah, so on that basis, you're good. This market's going. This becomes a significant level, all right? And the markets, we're running now. We're running on this smaller time frame. Look here. Look at all of this structure here. Can you see any structure in here that this market's broken? No. So all of this stuff seen here hasn't actually broken any 5-minute structure. The 5-minute structure is here. You see? So all of this is just fraff. All of this is a trading between here. Okay? Market comes down here, doesn't break this structure. So it's making a higher low, keeps going. Indication, this is an indication here. Look, above this level, this is an indication of what it wants to do. After the indication, what are we waiting for? Correction. After the correction, what are we waiting for? Continuation. If I wanted to, I could have taken another position with my stop over here. So now I've got 3 positions. All of them, because I moved my stop, are risk-free, apart from this new one here. So I've got 1 set of risk, but I've got 3 positions now in the same trade based upon structure. So this trade would have been here. This trade would have been, and this is me showing you on a 5-minute time frame. I would have got a much better entry on a 1-minute time frame. This trade's now sitting over here at a 1 to 1.5 or 1 to, let's just say 1 to 2 because 1.8 over there. This trade's sitting here at a 1 to 1.5. I'm going to round everything up because I want to make it sound good. So this one's saying 1 to 2, 1 to 2, that's like 1 to 4. And this initial trade is out here sitting at a 1 to, here's information, at 1 to 3. So we've got 3, 4, 5, 6, 7, at 1 to 7 trade based upon 5-minute entries. Now I got in here on a 1-minute entry. Yeah, but I'm just saying, based on 5-minute entries, I could have had 3 positions, all running, all with stop losses in the right place, as in these are all risk-free, and all with my, based upon structural breaks of major structure. And ultimately, we believe that this market is going to go and capture this liquidity. And on the bigger picture, have a look, on a bigger picture, this market should be running up here to try and grab this liquidity. Now we're going to break this little level of these equal highs. When we do, I'm going to look again, and you should be looking, if you're not already in the trade, for an indication above this structure, this blue line. Then we're going to be waiting for a correction. And then we're going to be waiting for continuation. And if we're clever enough, we'll be able to get involved in that continuation down here. Yeah, if we're clever enough, we'll be able to get into that continuation down here. Yeah, saying, okay, we at least want to get to this equal high, which we go and we get, and then it continues to go, and that's laughing our head off. By the end of the week, we're up here going, right, that was a major trade. So let's see how that pans out. I don't have no problem with leaving that trade risk-free and just letting it run and see how that pans out. All right. Now, remember, we was talking about the correlation of the US dollar. We was looking at the Dixie, and we was looking at the JXY, and we were saying that it looks like the US dollar wants to gain strength, and it looks like potentially the Japanese index was at the top of a range. Look, even if I just bring it up now, my markup should still be on there. It was at the top of the range and potentially wants to lose some strength. Look, this was the markup. This is us turning around and saying that potentially this market has come from here, it's at the top of this range, even though it's kind of going sideways at the moment, potentially wants to lose strength. And if we go to our Dixie, and that's just on the basis of premium and cheap. And if we go to our Dixie, when we was analyzing it, we were saying that we was in this range, and the market looks like it wants to potentially push up. Let's have a look. It hasn't quite got to the top of this range if it's trading within a range. So if we're talking about the market ping-ponging, it potentially wants to pong back up in this direction here. All right. That's why, we may have seen some, if I drop my time frame down to an hour, we saw breaking structure over here. All right. The market pushing down here, then breaking structure, and it pushing up in this fashion. Right. So the US dollar gaining strength. So we was looking at that UJ, and if the US dollar is gaining strength, and the Japanese yen is potentially losing strength, and that's why we understand why we're seeing UJ bullish. All right, let's have a look at Trading View. Look at US 30. And so, Jivan, I can see you there in the charts, inside the charts. Yeah, talk to me about right now where you are and what you're finding difficult in regards to looking at these markets. Like what?
Do you know what's one thing, yeah, that I'm trying to wrap my head around is this lot size. Is that lot sizes? I'm talking to a couple of my brethren, and they've been telling me, like, obviously I'm staying in my own lane and just kind of learning my thing, but it's just a thing of understanding. To my understanding, yeah, I thought you had to have, I think it was 10,000 in order to use a 0.1 lot size. But he's telling me that you can up your lot size with still like less money, if that makes sense.
All right.
Does that make sense?
No.
It probably sounds confusing because I'm confused. It's like,
wait, so 10,000 quid, you mean? 10,000 pounds?
Yeah, like to my knowledge, what I've learned, yeah, it might be wrong, it might be right, but I watched something on YouTube where it said in order to use like 0.01 lot size is £1,000. 0.1 lot size is 10k, and then I think one whole lot size is 100,000. Is that right or wrong?
It's correct to an extent, because the point is that in Forex, they give you leverage. Do you understand?
Yeah.
This isn't like investing in a company. When you're investing in stocks, you have zero leverage. You want to buy £10,000 worth of Apple shares, you need £10,000. Do you understand what I'm saying? Yeah. In Forex, they give you leverage, meaning that number that you're talking about is the money that you control in the markets. It's not the money that you need, because I'm your sponsor. So you can come up, rock up here with 100 quid, and I'm going to give you 100 times that money. 200 times that money, or 500 times that money, or 1,000 times. The brokers, I give you 1,000% leverage. It just means it allows you to get in the market and control more money. That's not what you need. The whole point of Forex is that Forex allows you to get in the markets with very small amounts of capital because of leverage. Leverage is like me turning around and saying to you this, like, I'm your sponsor, bro. I said, how much money have you got? You go, I've only got 10. I said, cool, bro. I got you 10 times whatever you got. I got you. You feel me? So when it
Yeah.
comes to taking a trade and make it and placing your lots, don't worry too much about that metric. Understand this, that you're going to use this calculator, which is
Yeah.
cashback forex calculator. When you're getting in the market, let's imagine that you was getting in USD JPY. All right. You're going to simply understand how far you want your stop in pips from your entry. So you're going to be able to go in here and you're going to say, okay, if I'm going to go and take a trade like this, for argument's sake, and you can see here, it's got a number says 251.8.
Yeah, I see that.
That's your pips. Yeah. So if I say I want to place my stop down here and I'm going to enter here on the basis that I'm going to go up here, I need to understand that my stop is 251, let's say call it 250 pips away from my entry. So when I go to USD JPY, I want to type in my stop. So 250 pips is my stop loss.
Okay.
Do you understand? So therefore, this is my account size. So my account size is 100 grand. My stop loss is 250, and this is my risk. I only want to lose, if I hit calculate, $100, which is 0.1%. It's not even 1%. Let's say, this is for argument's sake. I only want to lose 1%, which is $1,000. This will be my lot size. 0.6 will be my lot size. Okay.
So it's like, look. No, go on. Continue, finish, and then I'll.
It's like I'm trying to take £1,000 and spread it over 250 pips. So for me to spread that $1,000 over 250 pips, the lot size is going to have to be 0.6. If the lot size, if I came over here and I saw that same trade and I was like, you know what? Wow, I've got a fantastic entry down here, and my lot size is only this is 60 pips. I'm taking the same $1,000 risk and squeezing it up into 60 pips. So if I squeeze up into 60 pips, obviously my lot size is going to be bigger. Look, I can now put a lot size of 2.5 now because it's the same 1,000 pips, but $1,000, but squeezed into a space of 60 pips. Do you understand? So the point is this: even if I got an entry for 1 pip, if my stop, this is a 1 pip. This is say 8 pips. So if my risk is, I'm going to risk 1% of my account is $1,000. That just means every time I take a trade, I can lose $1,000. Yeah. But the benefit is now my lot size now is 18.8, meaning every time that we move a pip, I'm going to be making considerably more money. Yeah. I think this would be about $180 every time that pip moves. Whereas
and the reason why it's increasing more is because your stop loss is less. Is that what you're saying?
It's increasing more because I'm squeezing the same amount of risk, which is $1,000, into a smaller space. So look, the best way to think about it like this, bro. It's like I'm spreading butter. It's like spreading butter. Yeah. If you got a little piece of toast like this, but you're gonna spread a whole 5 grams of butter. That butter's going to be sitting hench on top of that little cracker there. Do you understand what I'm saying? So you're still getting that 5 grams of inflammation, and you're just killing your body.
Compressing it into
a smaller space. Yeah. So therefore, for every mouthful, you're getting more butter. All right. So for every pip, you're getting more profits. Do you understand? But you're still, if you eat that whole bit of cracker there, watch my finger.
I'm listening. I'm
cracker. If you eat that whole bit of cracker, you're still getting that 5 grams of dairy in your body. Now, if I took that and I made it a big, massive piece of hard or pizza base, pizza base, I'm still giving you 5 grams of butter, but I'm spreading it now across the whole pizza base. So every time you take a bite, you're not getting 5 grams. You might only got a 0.2 gram. So every pip, you only made 0.2. Every pip, you only made 0.2, but you've got a much bigger area. Do you understand what I'm saying? As in, you've got this.
So the area, all right, cool. So you just explained that with the butter thing, yeah?
Yeah.
Transferring that now into the markets. The market is obviously the bread. The butter is what the money that you're trading with, I'm assuming.
So the butter is going to be your lot size, and this stop is going to be your bread. All right. So look, if I put this stop all the way down here, I've got all of this space here between my entry and my stop for this market to move, which makes my trade a little bit low risk. It makes it lower risk so I don't get stopped up. Because remember, regardless of whatever happens, I'm still risking $1,000, bro. Doesn't matter whether or not I've got 100 pips or I've got 5 pips. I'm still risking $100 or $1,000 or whatever you want to say.
The bit that's not clicking in my head that needs to click is how you can. You're saying you can use the same money but make more per pip. That's what's not making sense.
All right, so have a look at this. Have a look.
Yeah.
I'm not moved. Imagine this trade went all the way up here. Can you see the numbers on this thing here? It's showing.
Yeah.
It's showing here that the risk to reward from this trade is 2.6, meaning that I made $2,600 from this trade. If I took this trade. 2.6, and which is like 260% return on my money. Okay. Now, that's because I spread my $1,000 over this huge piece of it. Okay, meaning that every single pip, the bites of the pip, every single bite that this was moving up was only incrementally giving me a small bit of butter. To spread it so thin. Now, if I was to spread it thicker, because I had a smaller bit of butter, have a look at that number going up. That same trade going to the same place is a 1 to 11. Because that's that $1,000 I've crammed into here, meaning that instead of it being, for example, 0.2 as my lot size might have been 5. Do you understand what I'm saying? Yeah. Now, what's the benefits of that? The benefits of that is that I can make a lot more money. But I've made this smaller, I can get stopped out a lot easier. And remember, regardless of whether I'm at a 5 lot size or 0.2 lot size, I'm still always risking the same $1,000. I can still always lose the same $1,000.
How does that work though? Like, I understand that, but how does that even make sense? Like, if that stop loss now will always be 1,000 because you've entered your trade and you know how much money you're putting into your trade. That's why.
It works because what's adjusting, what's changing is your lot size.
Yeah.
You understand what I'm saying?
I'm going to do more research into it, but you're defo...
No. I want you to get this because it's a good question. If you don't understand, this is fundamentals. What's changing here? Every time I change this pip size, is not the amount of money. Look, it says money at risk. I am not changing the money at risk. The money at risk is the same. Do you understand? I'm changing,
the money at risk is the same because of the money that you put into your trade.
The money at risk is the same because I am using a calculator and I know how far I'm
you want to put your stop loss.
Exactly.
Okay,
I know that that's going to be 8 pips away. All right.
Yeah.
So if for example, I might not want to, if I wanted to change this money at risk, then I'm going to change my risk and say, you know what, I don't want to risk 1%, I'm going to risk 0.5%. So now that same 8 pips is going to be only $500 risk. But look, you've just seen it jump. That lot size has gone.
So this is why the pip calculator is coming, because you say, all right, cool, I only want to lose 1%. It will tell you how many pips your 1% is. And then that's what you put into the market, basically.
Exactly. That's the lot size that you will enter into the market.
So lot size isn't even something you need to think at the forefront. It's more
about you have to think it at the forefront. It's essential. Yeah, it's essential. But the point is, what you was going to say, yes, it's about your risk.
Yeah.
The bottom line is this. I'm interested in this number. I only want to lose $500. So if I take a trade, remember, every trade's different. So another trade I'm going to take, the risk is 25 pips. Still losing $500, but now my lot size is free. And then I take another trade and I go, oh my gosh, it's a great trade. It's on a 1 minute entry, rare tete, and it's 3 pips is the risk. Well, now my lot size is 25 lots per pip. Every time it's moving 25. It's a 25 lots I've got on there. Do you understand what I'm saying? Yeah. I've basically trying to say that, and this trade, I execute this trade, I can still use the $500. The same as if it was a 300 pips, I'm still only risk. Oh, it's too big. Let's go Oh, no, it's not. Look, I'm still only risking $500, but now I'm at 0.2. Just a minute ago, I was at 25. You know, every time I take a bite, I'm getting 25 grams of butter. You get what I'm saying? Yeah. Now, every time I take a bite, I'm getting 0.2 grams, which is not a problem. It just means that I'm going to make less money on the upside.
Yeah.
Because every bite I take is only 0.2.
Yeah.
Every bite I was taking before was 25. So I was taking a 25 grams. By the time I get, up the ladder, I'm going to be like, all buttered out, bro. I'm gonna have eaten so much butter. Man, I'm gonna be like, rah, bro, you're gonna be dying of some different kind of disease because I'm taking big chunks. You understand what I'm saying? So it's the same money. It's the same money at risk. It's always about a lot size. It's like a gear. The lots are like your gears. Do you understand what I'm saying? You can drive at 100. You can drive at 30 miles per hour in your second gear, and you can drive at 30 miles per hour in your third gear.
Yeah.
You understand what I'm saying? Yeah. But one's going to give you more acceleration. The lower, do you get what I'm saying?
Yeah.
It's like you're moving at the same speed. Go on.
No, land.
No, go on, because it's for you to ask a question.
I'm saying cool. So I've got that bit now where basically your risk, how much you want to risk will represent how many pips your risk will be represented by. Yeah, I've understood that. And then now it's about like what I'm trying to understand is basically like how you control the lot size now, like how you can use that to your advantage when you
enter a trade, you have to enter a lot size. When you on your MT4, MT5, you must enter a lot size. All right.
Yeah.
So for argument's sake, if I was to go, I'm going to show you, pull up an MT5 chart. Let me open one up.
I use that still. I see it. But that's why I thought you had to have a certain amount of money to access.
No, you don't.
Certain lot sizes. Yeah.
No, you don't. Well, look, you do, because the point is this. Like, look.
Yeah.
I can't put in here. Let's imagine that I've only got £100.
Yeah.
I can't put in a lot size in. I can't turn around and say that. Let's imagine that this is 5 pip risk.
Yeah.
And I want to risk 1%. Okay. So look at this lot size. All right. If I'm risking it's 0.03. I've only got 100 quid. Watch this. If I put in 20 quid here, I can't take this trade.
Yeah, because it doesn't offer you that lot size.
It's telling me my lot size. My lot size is 0.006. Yes, but I can't put 0.0. That's not even one.
Yeah, that's what I'm saying. It's not a unit. Yeah, it's not a metric.
Because I don't have enough dough to take this lot size. Now I could take it. I don't have enough dough to risk this. Now that's why there's like a minimum level, but you don't have to really concern yourself. That's why when you hear people say, if you're going to trade forex, they'll say, at minimum, open an account at 500 to 1,000 quid. Because that 500 quid
will give you access to certain.
Yeah, it'll be on 0.1 like this. This would be your lot size, but at least you're able to get into that trade, and you're risking $5. Do you understand what I'm saying? So you can't be in a trade. So I'm going to risk 1 pence, because man, like, what are we talking about? Like, you've got to be in there at some sort.
So with this now, this is the last kind of thing where I need to land with. Is with this same $500, and your lot size would be 0.1 if you wanted to risk 1%. Yeah.
And your stock was 5 pips in that.
But you didn't put that. Did you put the 5 pips there, or it told you 5 pips?
No, I put it. It can't tell me, because it's dependent upon the trade. If I look at this trade here and I'd measure it out, this stop here is 206 pips, for argument's sake. So if I wanted to take this trade, my stop is going to be 206 pips. So I come to my calculator, I type in here 206 pips.
Okay, you've done calculated it.
Yeah. And then I hit this button and hit calculate. And then this is, and as you can see here, if I wanted to take a stop that was 206 pips and I only had a $500 account and I wanted to risk only $5, I couldn't even take that trade. It's too small. That's the only capacity in regards to you need a certain account size, because obviously I wouldn't be able to take a trade with a 206 pip risk. I might be able to see a better entry on a smaller time frame at 20 pips. Yeah, I can take that trade. Look, 0.3.
Yeah.
Or 0.03, I should say. Do you understand what I'm saying? I could take that trade. So all you need to understand is this. This is what you need to understand. Forget about whatever YouTube or whatever your brethren are saying to you. Yeah.
Yes.
When you go and look at the charts and you understand I want to take a trade. And you're here and you say, okay, Jay, I'm taking this trade. I've seen it, indication, correction, continuation. I've used this tool here and I want to place my stop below this low. Okay.
Yeah.
You're going to look at this number here. This number here is the distance between your entry, which is here, and where you place your stop. So I want to place my stop below this little low here, and that number is 73. You must take that 73 number and put it somewhere. You must put it here. You understand? So you must find your pair first and foremost, USD JPY. You must go in here, and when you initially open this chart, this will look like this. It will give you the numbers. You don't want to worry about putting in the numbers. That's long to try and have to go in here, find the actual number of your USD. This ain't even USD, but you get my point. Find the actual price and type it in. That's long. You don't need to do that. You don't need to go here and go 150.779. No, you want to go understand that you want to change this to pips. So you click this little thing here, says switch to stop loss in pips. And then in here, you want to put in your 73. That was the number that you saw as your pip size. Furthermore, you want to round it up. This is round it up to 75. That means you're saying you were taking 75 pips distance.
To lose your 1%.
For your 1%. You see, to use your 1%, you can use it like that. You hit calculate. So let me put a decent number. Let me put like a 10,000 in there.
Yeah.
So now I'm risking 1% of 10,000, which is $100. And if I want to risk $100 over the distance of 75 pips,
it'll be 0.2 per pip.
Exactly.
Okay.
And if I got a better entry, I was like, oh no, I've seen an entry even twice as good as this, only at 30 pips, for argument's sake.
Yeah.
This is gonna go up because I'm squeezing that $100 into less of a space. See, like now my new
yes.
You understand what I'm saying?
Yes, it's landing.
Do you get what I'm saying?
Yeah.
Because I'm always, regardless whatever this lot pip size is, this distance is, I'm always, I'm always risking this $100.
100. Yeah.
That's why people turn around and people say to you, so newbie traders, you hear me say, I don't want you in the 1 minute. Because in the 1 minute, though you might be able to get these huge, lot sizes, is that your distance, your potential to get stopped out because your risk is so small is high. Because you've only taken
it's a high risk, because
and you're still risking your same 1%.
Yeah.
It's not to say that you're risking less, you're risking the same amount. So you're better off taking a bigger zone and risking that same 1% in there and making some profits than trying to be greedy and saying, oh, I want a massive lot size. Let me tell you something. When the bigger you put your lot size, you're going to be looking at the money just running up. You're going to be looking at it going, wow, every time it moves, you just make $200. You just make $200 every time the candle moves a little bit. You're making lots of dough, of course, but that also happens in the opposite direction. In the opposite direction, it only has to move 5 pips if you're doing $200 a pip for you to lose $1,000.
Yeah.
Do you understand what I'm saying? So this is where newbie traders, and this is the battle that even experienced traders get. Everyone wants the big lot sizes because that's how men are going to be like, rah, I made 100 grand because my lot size was massive. But for you to have big lot size, you're either going to have to have a very big account so that 1%, have a look. Look at the difference. That same 30 pip trade, all right, on a $10,000 account, I have to make my lot size 0.5 if I'm only risking 1%. But if I've got a bigger account, look, 100,000, $1 million, $10 million, that same trade, nothing's changed apart from my account size. That same trade now, instead of putting a 0.5 in, 502 lots in. Because this is a massive account. So if I drop this down to £1 million, every single pip now, boom, 50 lots, 50 lots, 50 lots. If I drop it down to 100, it's the same trade. Nothing's changed apart from my account size. Look, you can see this always changing to 1% of that account size.
Yeah.
This is why you hear people turn around and say that, they say, oh, we risk 1%. If you want to make more money, you have a bigger account balance. However, which way you're going to get that money, whether you're going to get that money from someone's going to borrow that money, or it's your own money, or you're trading somebody's funds, you make more money by having a bigger account size, not by risking more. It's the exact same trade. The same trade that I took in the UJ, someone else took that trade in UJ, but the only difference is that they had $100 account or they had $100 million account. So therefore, their lot size would have changed, but everything else would have stayed the same. Their risk would have been the same. This would have stayed the same. Only the risk and the money at risk would be relative to their account size. Do you understand?
Yeah.
Every single trade you take, you're going to be able to look here, see what this measurement is. So say for example, we're taking a trade. You'll see this number here saying 45.3. Okay, that's 45 pips in USD JPY. That 45 number must go somewhere here in this calculator, and it goes here. Yeah. It goes in there, and then whatever your account balance goes in here, and then whatever you want to risk goes in here, and then you hit calculate. It choose those numbers up and says if you're taking a trade, Jay, on USD JPY where your stop loss is 45 pips, and you've got this is $1 million account, so let's drop it down. You've got $100 grand account. Your lot size is going to be 3.35 if you want to only lose $1,000. That's what this calculator is telling me. So when I go to my trade, I put 3.35 in, and then I hit the button, and I place my stop loss 45 pips away. You will get it with practice. All right. You will get
This I'm way more clear on it than like 10 minutes ago. So it's definitely like, you know what I'm saying?
Good. You will get more clear. But you just have to understand like this. I don't want you to think about this in numbers and think about this and close your eyes and think about it.
It makes sense.
Just think about it like this. Think about it like this.
Tell me.
Your brethren or your son or your cousin, your cousin. You're sending your cousin to, he wants to go to the camp, there's a holiday camp. You're gonna say, no problem, here's £10.
Yeah.
You've got £10 to spend in however way you want to spend. If you want to spend that first £10, the first 5 minutes into camp when you go into the first sweet shop, or you want to make that £10 stretch over the whole duration of the day, that is down to you. But you're gonna have to, obviously, if you want it to stretch over the duration of the day, you're gonna have to spend £1 an hour, £1 an hour. You're at this camp for 10 hours, £1 an hour, £1. You're gonna have to make it stretch over that duration. It's the same £10.
Yeah.
You're not losing any more money out of your pocket. Now, if they wanted to, they're gonna go in there and they're gonna go nuts in the first hour of the time they're being there, and they're gonna spend that whole money within that first £10. It's like in comparison to the trading, if that was continued, that could be continued every hour. They'd be spending this £10, spending this £10. If in the trading terms, obviously it's a bit confusing, But the problem, your risk is always going to be £10. Do you understand what I'm saying? Your risk.
It's just about how long I give myself to lose that £10, how much space I give myself on the market.
Exactly. Are you going to turn around and say that 45 pips is going to be the same? So your lot size has to adjust to make sure you stay there. If for whatever reason you put the wrong lot size in here, you will end up losing more money than what you wanted to risk. This is why I always say you should be conservative with your risk. If this says 3.35, bro, just put in 3. Do you understand what I'm saying? Don't even worry about putting 3.3. Just put in 3. Be conservative because you want to stay underneath that. Because I'm telling you, when your cousin comes back, think about it. It wasn't even, let's say it wasn't cash you gave them. It's your credit card. When your little cousin comes back and says you gave him a £10 budget and he came and goes, I spent £18. You're pissed. You gave him £10 to spend. So it's better if he comes back and says that uncle or cousin, I only spent £9. Cool. You had £10 to spend. You're within your risk. So this is why I always say be conservative. And I'm telling you, as traders have a problem with this because they always want to make this number, lot size, as big as possible. They want that lot size to be massive. They want to be in a trade that's going in the right direction. Right now, I'm in a trade. Have a look at this US 30 gone to hell. All right, I'm in there for the sell. We spoke about it. I put it in the group also. Look at it. Going to hell. All right, if I drop my time frame down, it looks more impressive.
Where did you enter up there?
Yeah, I was up in space, bro. I ended up here. Yeah. Now, the point is this. Whatever that risk was that I entered, I'm now looking at that trade like, wow, that trade went for 1 to 9, 1 to 10. Wouldn't it be great if my lot size had an extra 0 on it? Of course it would. So as a trader, you always want a bigger lot size, but the bottom line is it's not how much money you want to make, it's how much you are willing to lose. That's how you have to measure things.
Yeah.
It's not how much money that you might possibly make in a fictional scenario if the leprechauns and all the stars aligned. You can't live like that. You have to be like, I want to be understand what my risk is. I want to quantify what I'm going to lose.
Yeah.
You feel me? So the
I'm
calculator for you is something, I'm telling you, you should not be taking a trade if you are not using these calculators. You're going to hear your friends saying, yeah, I just go and I just do 0.1. I just put a 0.1 in, or I just do a 1 knot whenever I take. That's not trading because they're not quantifying this risk.
Yeah.
They're not saying I'm only going to, they're saying, I'm just putting in this number, this arbitrary number that I've just come to a conclusion in my head, 1. Let me just put in 1 lot. That doesn't mean, because one of your guys have got a 10 grand account, one's got a 100 grand account, one's got 50 quid account. So how can you all be putting in a 1 lot?
Yeah.
Do you understand what I'm saying?
I'm thinking, this is why I had the questions, isn't it? This is why.
No. It's a sick question, bro, because you're new and you want to know that, and knowing this,
I want to understand.
Pivotal. It's pivotal, bro. Because if you start putting in the wrong lot sizes, you will blow your account because you're gonna lose.
Of course.
You're gonna lose. But now, if I'm making sure I can always only lose 1%, technically, not really in real life, but technically I can lose another 99 times.
Yeah, technically.
But technically. Your broker's not gonna allow you to get all the way down to there. It's gonna the same thing. But the point I'm making to you, if for whatever reason you're just putting in some arbitrary lot size numbers, maybe one trade is 1%, maybe one trade you took was 8%, maybe another trade you took was 20%, bearing in mind you're just putting in one lot.
Yeah,
like that is not going to. Before you know it, you would have blown your account for just right. How did I blow my money like that? It's like, what happened? Do you understand what I'm saying? Yeah. So you have to make sure that you get very, very comfortable with this. Now, the only difference is here, which I didn't bother with. I purposely went to a forex pair instead of an indice pair. Is when you go to an indice pair like US 30.
Yeah.
There's a slight additional nuance that it adds, which is about your contract size.
When you say nuance, what
it's
do you mean?
It's a slight difference. Contract size. Yeah. Cool. So the contract size can either be 1, it could be 10, it could be 100. This depends upon your broker, and it will affect this lot size. So for argument's sake, if I go in here and I'm saying I'm in US 30, there's a trade I was going to take, it's 45 pips. This contract size is saying that if I want to risk $1,000, it's 0.01. But that's wrong. I knew it's wrong straight away. You know, if it was 10, now we're going to it being 22. If it was 1, I'm saying
this is moving different because it's indices. You're saying
it's only the indices where they're going to ask you about this contract size. Okay, and like I said to you, it's even telling you how in MT4 and MT5, right click a symbol and then click specifications, and the contract size field tells you how many units are in one lot. So I'm going to show you that. If I go to US 30, can you see here? All right, this is my MT5. If I go in here and I can find US 30, click it. This is click specifications. You can see in here contract size. 1. So that number here should be 1. Yeah, and then potentially, you know, depending on that number here will be 1. Sorry, all right. So therefore, it's just basically saying to me, that's going to be this here pip size may adjust as well. And someone asked me about this the other day, and I said the best way you go about doing this is testing it. Your very first trade, you test it with a very, very, very small lot size. Yeah. Just to make sure that you only lose what you can see it straight away. As soon as you enter that trade and you start putting out your stop, if you start seeing it jumping by $100, $100, you're going to know, whoa, I'm in way too big. Close that out and understand that this isn't 1. It might be, 10. Okay. That's the only nuance. And I say the only little thing that you need to worry about from the indice pairs to Forex pairs. But when it comes to normal, just Forex currency pairs, you don't have that problem. So you go to USD JPY, it's not even going to ask you anything about contract size.
Yeah.
It's just going to have it in here. You just don't touch it. Leave it. It's fine.
So you see, just to top all of that off here, what you said, is there a way now where you can manipulate your lot size by using the same amount of money?
You can have a change in lot size because this stop loss distance. because you've got a better entry. You can say, you know what, I'm only putting
This
my
is
stop
aside
loss.
from the indices now, you know. This is going back to like the
Yeah,
currency.
going back to normal
Yeah,
pairs. The only
yeah,
way you
yeah,
can manipulate this, as in
yeah,
change this, that's the word
yeah. Like to
manipulate.
make it higher.
Yeah, is by making your stop loss smaller.
Yeah,
So it's not going to be 45, it's going to be 20. But if it's not 20 on the charts, it's no point me trying to turn around and just say, I want to make a bigger stop loss and bigger lot size. So I'm going to move my stop here, because you've got to place your stop in the right place.
yeah. Of course, of course. Yeah,
You know
yeah,
what I'm saying?
yeah.
So you can't really manipulate your stop unless you're going to do that,
Unless you're in a good trade, unless it's like the one
or
kind.
even then, you can't, you know, or you're going to increase your risk. That's another way you can think. You can leave this at stop loss,
Yeah,
say, okay, I've left my stop loss to 45 pips because
yeah,
that's what the structure is. But in this trade, this is what you're saying. If it was the one, which
mm.
yeah,
Yeah. I know you don't like using
you can
that
say, you know
term. I
what, I'm
know.
not going to risk 1%, I'm going to risk 2%. I'm
Yeah,
willing to risk 2 grand. Now look, your stop loss is doubled. I mean, your lot size is just doubled.
yeah, yeah. Theoretically, yeah,
Yeah, your lot size is doubled. So you can try and say, you know what, right, this trade is so amazing, I'm going to risk 2% on this trade. Yeah. Now, if that is in your trading plan, that you're allowed to take higher risk on great trades, then you can say, I'm going to risk 2%. So your lot size is going to be a lot bigger. But just know, when you lose, you've just lost 2 grand.
yeah,
Did you get what I'm saying? So it's
yeah,
like, that's why we stay at 1%, and we just say, you know, there it is, 3.35, that's your lot size at 1%. And if you're doing a prop firm challenge, remember, you can only lose 10% of this. All right.
yeah.
So therefore, you only want to lose $100. So now your lot size is 0.3.
And you want to spread that $100 over the maximum amount
Well,
of
you want to
pips.
spread it over wherever your loss, wherever you've placed your stop loss. So if that stop loss is 45 pips away, you've got to
Yeah,
spread your $100 over that 45
yeah,
pips.
yeah,
That's it. You
yeah,
can't, there's no negotiating.
yeah, yeah,
If that's what you want to do, you have to spread your $100 over 45 pips. If you got a better entry at 15 pips, well, great.
yeah,
You're going to
yeah.
spread your $100 over 15 pips, and that's going to give you a thicker
A
chunk
higher
of
lot
butter on
size.
that toast. And now every single bite, you can put it at one lot instead of it being 0.3.
Yeah, it's landed. It's landed.
You understand what I'm saying? Like that
Yeah,
distance, this stop loss is non-negotiable. If you're doing your technical analysis and you've seen it, this is where you have to place your stop above this
yeah,
high. That's 80 there, that number 79.3, let's just make it 80. That is non-negotiable.
yeah. So you
Because
gotta
the
work
aim of the
around
game,
that.
because the aim of the game isn't to just put a big lot size. The aim in the game is when the market kicks back on you like this,
Mm.
the aim of the game is that you stay in the trade and actually get to the point where you're going to make some profits. Because if you
Yeah,
put 100 lots in here, if you get stopped out, who gives a damn? You're going to lose that same money. So this stop loss place is non-negotiable. Yeah.
yeah.
The only thing
Yeah,
you could do if you're a lunatic, yeah, or if you know it's within your trading plan, is I could say, you know what, with this risk, with this trade, I'm not going to risk 1%, I'm going to risk 2%. Meaning now I'm not cramming $1,000 into this 80 pips, I'm cramming
yeah,
$2,000 into this 80 pips.
yeah,
Meaning I've got more, there's more bang for my
yeah,
money.
yeah. I understand. Yeah,
There you go. That's it. So now when you're practicing, make sure
yeah,
every trade you take, when you see here, you go back over here and get very, very comfortable with how you use this calculator. There's loads and loads of calculators out there, but for me, this one's just like the cleanest that
yeah.
you can use. Yeah, quite straightforward. Just use it. It's Cashback Forex. I'll put the link. Right now in the chat. And if you can, just click it so that you can get it on your screen and just save that domain. All right. But the reality is you want to be using this calculator every time you take a trade until you get to the point whereby you're trading a particular pair and you just know the lot sizes off by head. You know that 10 pips is X lot size, or you know that 100 pips is X lot size when you know it in your head. But until then,
Yeah.
every time you take a trade, you must use the calculator. If you are not, you are gambling because you're not quantifying this risk. You're not limiting the downside. All right.
Yeah.
No problem. We're
Knowledge.
going to do some more of that. And it's a very good question as a newbie because I'm certain there are people who know how to enter the trade, know how to do certain things, still don't use that calculator every single time. And just so you know, have a look at my US 30 going to hell. Yeah. Currently 4,600 up. All right. So that's doing bits. It's good. And the USD JPY, let's have a look at USD JPY also, which is what we was talking about. Let's see if it's still going towards that liquidity or has it taken a retracement. Still going towards that liquidity from what I can see. Let's have a look. And drop my time frame down to 5 minutes. No, it has taken a retracement here. Has broken structure, indicated where it might want to go. The question is it going to correct and then continue coming down here? I'm not going to place no bets, but I'm hoping it doesn't. I'm hoping that it keeps back up in here and keeps going. Either way, my stop is all the way quay down here, and I'm just that's risk-free, and I'm just letting this one run to see what happens. All right.
Yeah.
Good morning.
Yep.
Good morning. Good morning. Good morning. Good morning. God bless. We have run
Yeah.
on. I'm happy that you asked that
I
question.
need to come in there quickly because I'm
Go
going to
on.
jump in the meeting in a moment.
Love,
This
bro.
US GDP news at 1:30. The markets will go haywire at 1:30. Yeah, right. US GDP news at 1:30 today.
Jeez.
Yeah,
This one
right.
here.
Yeah, that's the one. Yeah, right. If the market is over, if it goes above, if it comes in above 3.3 GDP, the US dollar will be strong and the indices will be bearish. If it goes below 3.3, dollar will be weak and the indices will be bullish. All right.
Below 3.3
If
bullish.
it goes up, yeah. If it goes above, that means the US economy is still strong. And because the job market's strong, I believe the US economy is going to be strong. So I believe the indices will be bearish and the dollar will be strong. That is my analysis over for the GDP due to the fact that jobs is strong in the US at the moment.
You was right last time. I remember you made your prediction. You was slap bang on. So definitely we're going to be looking at that. So at 1:30, you're either going to be out of the markets, taking your profits, or you are going to be sitting it out, seeing what happens at least for the first 20 minutes, half hour, before you make your decisions. But good information to know. I'm looking at this USD JPY, and I'd like it to get based upon from technicals. I want it to come out so the USD gains strength. So what is that? It being below, did you say below 3.3? I think you said.
If it goes below 3.3,
yeah,
the dollar will be weakened.
Okay,
if it goes above 3.3,
I want it above 3.3. Based upon my technicals, I'd like to see that above 3.3. I'd like to see this rallying up here, and I'd like to see our indices going to help, and continuing to fall. But we shall see. But guys, good morning, man. We ran over, but I'm happy that Jivan asked the question because that is a massive bit of your trading. And when you talk to your friends, you can let them know very simply like this: every trade I take, I must quantify my risk. Okay.
Yeah.
Therefore, as I'm a trader and I'm not a gambler, I only want to risk 1% per trade. So I have to use a calculator. Why? Because my stop loss in pips changes every trade. Every trade I take, the stop loss ain't going to be 10 pips, ain't going to be 20 pips. It's going to be dependent on the structure. So therefore, I must use a calculator to give me that calculation to make sure I stay within this risk. So when you open your demo account for 100,000, you say, okay, I'm going to risk $1,000 per trade, or maybe open it for 10,000. You're going to risk $100 per, whatever you want to do. Every single time you take a trade, you're risking that $100. The only thing that's changing is how thick, what distance you're spreading that $100 over. Is it over 50 pips? Is it over 5 pips? And when that changes, your lot size, just like a gearing mechanism, would change. The lot size is going to be bigger or smaller depending upon how thick you spread that same $100. Do you understand?
Yep.
Guys, have an absolutely blessed day. Even though we ran on, I had fun. And now my recordings are still working. It's not really a session that I'm probably going to put up. It's a bit there. So I'm not going to delete it off of the YouTube. But what I would say is definitely open up your demo account, start taking trades, start looking at market. The more trade, like right now, Jivan, you need to build up muscle memory. You need to start taking trades. Open your demo account, bro, and start looking at structure, start taking a trade. But don't take the trade on the basis that you're going mad and you're taking trades for 50 lots and you're not go through the process to do things properly, But I know you're waiting for certain things anyway from me, so give me a moment and I'll I'll get onto you.
I'm
Yeah?
good, man. I'm just coasting along right now, just learning. Like I said, just you get me demo account. I opened it up for 1K though, not 10, but just to
Yeah.
do something realistic.
That's cool. That is
Yeah.
cool. I like the fact that you said that. Only thing I would say to you is this. If
Tell
you're
me.
trying to, maybe what you want to do is open a demo account, a bigger number. But this
Yeah.
depends upon your plan. Is your plan to go straight in trading your own money? I probably wouldn't advise it. Okay. I'd say to try and do one of the prop firm challenges. Okay.
Yeah.
So that you can control more money. Because it's gonna.
You'd have to educate me more on that on another session, innit?
I
Tomorrow
would.
or something.
I would.
Yeah.
I would. So, well, I'd say go to your account and I'd say open, open 100K account.
Yeah.
Okay. Because you can control 100K for about 350, 400 pounds of your own money. Now, I'm not trying to say that's where you should start. I'd say
That's
open a
what you
10K
can
account.
do.
Open a 10K account. All right.
Yeah.
So open a demo 10K account because you can control 10K in a prop firm for about, I don't know, 200 quid of your money. And then at least you get used to seeing
Those figures.
the numbers.
Yeah. Yeah.
It does
All right,
affect
then.
you. Do you understand what I'm saying? Like when you're
Yeah.
looking at right now in your £1,000 account, you're probably looking at 20 pence, a pound going up.
Yeah. Yeah. Like £1.23 and stuff.
Exactly. So it's a complete different mindset when you look down at your phone and you're like, rah,
127, 150. Yeah.
man, or 1,000 quid or 3,000.
Yeah.
And you have to get comfortable with it's just a number.
Yeah.
It's just a percentage of your account size. Because if you start looking and go, rah, I start getting excited, but it's just a number. You
It's
get what I'm
all
saying?
about the mindset, innit? You said it already.
Well, you know,
was the
innit?
word?
It's just, bro, it's like this.
Psychology.
It's like this. If somebody owes you £1,000, okay,
Yeah.
or somebody owes you £100,000,
Yeah.
man might be, or someone owns someone else 100,000. You might be thinking, "Well, man's taking a piss, owes you £100,000." Yeah, if you think about it, it's still relative to how much money you have. Because if you're a billionaire, that £100,000 is like man owes you a tenner.
Yeah. So
But if you've only got 100. If you've only got 100,000 quid, the man owes you 100,000.
That's it.
It's 100% of your dough, bro. You're gonna murder him, bro. You're gonna be chasing him in the street.
Yeah.
It's all relative. Do you understand?
I understand.
So when it comes to the numbers and trading, you just have to look at it as it's just a number relative to your account sets. You can't. Yeah, it's just a number relative to your accounts. Now I'm saying that, and in the same breath, if you are trading a real £100,000 account, you then have to put in common sense and think to yourself, the average man goes to work for how much money a day? How much actual money do you need per day to live your life of your dreams? So therefore, yes, that trade might go for a 1 to 5, but at a 1 to 2, bro, you're £2,000 up for the day. That's 10 grand in a week. That's 40 grand in a month. I mean, that guy that we watched the other day, it was that kind of Nordic guy. He's I can't remember his name. He's got some mad name. Yeah, he's a trader. He said he aims for 2% per month return. So it's 2% per month return. And man are like, right, okay, that's it's nothing. He doesn't care because he's controlling 4 million in funds. Do you understand what I'm saying? Yeah? Controlling 4 million in funds. Yeah?
Yeah, I'm listening.
Times by 2%. That's what he's saying. He's pulling in it. He's aiming for every single month, 80K. Now, 80K a month, bro. Even after he's paid whatever he paid, he can live whatever life he wants. But he's only making 2%, bro.
Yeah, he's not even going to, but he's made it basically.
He's not trying to make 20%. He's saying I'm trying to make 2%. That's not like he's gone mad. Yeah, I'll make 2% a month. He's just got a bigger account size. If he had £1,000 and he's making 2% a month, man, I'm like, right, you're not really living lavish off your £1,000.
Maintaining wealth.
It's just about, like I said to you, and that was quite powerful. That guy who's getting lots of interviews now said he trades capital, he trades consistently, he's fundamentally said he aims for 2% a month.
Yeah.
2. Bearing in mind the prop firms are asking man to do 10 and 5. Yeah, my man's doing 2% a month. After he gets his capital, scales down, he's doing 2% a month. All right, but guys, good morning. We'll go into it in more depth.
Yeah, tomorrow. Yeah,
for sure. Love and blessings. I'm going to put on Dr. Umar Johnson talking to Tate and something about different bits and pieces. But guys, if you're able to stay in the session. If not, I wish you having a great day. I hope you learn something and you're gonna take it on and do something. Yeah.
Most definitely.
Love, love, love. Let's put that.
Love.
Big up Jason. Big up Al. Have a good day, family.
Man,
Have a good day, everyone. Thank
Cool.
you.
Sunday to worship Christ. Are you kidding? Are you is this a rap video or is this a service for the Lord?
I think the main problem with black boys in America is that we don't do any soul searching. We don't take the time to be by ourselves and reflect on what's going on in our mind, what's going on in our life.
Focus. You gotta have that confidence, right? You gotta be like, yo, I'm fucking better than everybody. I will fucking smash everybody. Have a crippling insecurity, a fear of not being good at all, of being shit. And that fear drives.
You spoke a while ago about the allegiance to the black community.
Yes,
Are you familiar with Andrew Tate?
I am somewhat.
'Cause
I
he-
know who he is.
Okay, he tweeted at you, or not at you, he tweeted about you after your Joe Budden interview.
Yes.
He said, I don't care if you agree with him or not, Dr. Umar is ride or die for his people, and I respect that.
Absolutely. Race first.
Race first. Now, this is my thing with Andrew Tate. I love the brother. As a matter of fact, he's probably been one of the most positive inspirations in my life personally. From where I came from, he speaks about masculinity, about always wanting to better yourself, about surrounding yourself with brothers who have like minds so you can go and conquer the world. This is my concern. Not even my concern. This is my thoughts. He has a black father and a white mother, but he doesn't tailor his message to black boys when we need it the most. He was born in Washington, D.C. He was raised in Chicago. He left Chicago at the age of 7. And then he moved to Luton, England, when it's a council estate. This is more like a hood out in London. So I understand why he doesn't, because he wasn't raised around, at least I would assume, black people. But as probably one of the most influential men in the world, do you think he has a responsibility, or he should try to speak and tailor his message to black boys, especially from Chicago, where he was from?
When we have this conversation about the politics and psychology of mixed race Africans, it gets pretty deep. Because mixed race Africans, who I consider to be 100% my blood, kith and kin, as long as they identify with African, but they exist on a continuum. You have mixed race